You are listening to the Unlocking Financial Freedom podcast, episode number 6. In today's episode, I'm still continuing on our personal income tax series for the salaried employee and ways to reduce tax legally through implementing tax avoidance strategies. More specifically, I'll be going through the basic principles of tax, so stay tuned. Hello, sanibonani njani, and welcome to episode number 6 of the Unlocking Financial Freedom podcast. I'm your host, Usamkelo Magogo, but you can also call me Chief Kasi Economist or the Government Guy. This is part 2 of 4 on our series on income tax and tax avoidance for the salaried employee. And in part 1 of the series, I shared with you the importance of paying tax, and I used 2 analogies to emphasize my point. So the first analogy was taking care of the goose that lays the golden egg. In order for us to have a well-maintained country that provides us with a conducive environment, both economically and socially, we have to pay taxes and take care of our country, because if we don't, we run the risk of losing that conducive environment and losing the country itself. In order for us to have a well-maintained country that provides us with a conducive environment, both economically and socially, we have to pay taxes and take care of our country, because if we don't, we run the risk of losing that conducive environment and losing the country itself. I also mirrored paying taxes to paying tithes at church, and said that the tithes that are paid at church are used to take care of the physical building, the structure of the church, but also to implement programs of the church that will help members of the church and so on. And it also helps to take care of the management team of the church, or the government or the governance structure of the church and so on. Now, if you didn't get a chance to listen to that episode, I suggest you listen to it when you get a chance. Now, let's get into today's business. As I'm doing this series on personal income tax, I want to help you understand your tax and help you make tax-efficient decisions when it comes to your finances, when it comes to investing, when it comes to starting your own business. I want you to make the best possible decisions when it comes to tax, hence why I made this tax series. Now, before I continue with today's episode and get into the gist of it, I'd like to ask you this question. Do you know what your marginal tax rate is? In other words, do you know what your tax bracket is? I ask this question because knowing your tax rate is important, as it helps inform your wealth creation activities. For example, it can help you decide whether you want to invest through a life or endowment policy, or you want to invest through a tax-free savings account or a normal investment. All of those decisions will be informed by your marginal tax rate, because if you know that, you'll know how your investments will be taxed and you look for the most tax-efficient way to invest. It can also help you decide on what form of ownership you want to choose when you run your business. For example, should you choose a sole trader, or should you use an incorporated company to run your business? Amongst many other factors and components that go into making that decision, knowing your tax bracket is one of the most important factors, because it speaks to how your income that will be generated on that business will be taxed. So, do you know what your tax bracket is? Do you know what your marginal tax rate is? If you don't know, it's fine. I'll help you with that in today's show. Now, a lot of people would like to think that understanding taxes and the income tax regime of South Africa is a hard thing to do, and calculating it is a hard thing to do, but it's actually not. And even though you won't be a tax practitioner yourself, but you will be able to have meaningful conversations with your financial advisor, with your accountant, or with your lawyer when speaking about money and speaking about your taxes. You'll also be able to speak to your HR consultant at work or your HR personnel at work and have a meaningful conversation about your taxes and so on. And you might be asking yourself, why is it important to know how to calculate your tax liability? Because you only want to know how to avoid tax, and this series is about avoiding tax. So to answer that, I'll tell you that the first step in reducing your tax and your tax liability and ultimately avoiding your tax is to basically understand how is the tax determined in the first place. Once you know this, you'll then be ready to learn about tax avoidance. Now, think about it for a moment. How will you understand how to reduce your taxes if you don't even know how those taxes are calculated in the first place? So as a result, as much as you want to know how to avoid tax legally and pay less tax at SARS or get a refund, it's crucial and important that you must first understand how your tax liability is calculated and understand your marginal tax rate and understand your tax brackets and all of that and the rebates and all of the information that comes along with that. So, as I shared in the Financial Freedom series where I was talking about financial planning and wealth creation tips, I told you that the consequences of creating wealth is that you'll pay tax on that wealth. Now, the purpose of this series is to help you reduce those taxes that you'll pay on your wealth creation activities, whether you invest in shares or you start a business, whatever other wealth creation activity you want to do. But the mere fact that you'll be getting more money means you'll be charged more tax on that money if you don't know how to avoid tax in South Africa. So a lot of people are fed up with the government that they're not in South Africa. So a lot of people are fed up with the government that they're not adequately managing the resources of the country, and they're giving jobs to pals, and they're not managing the state-owned enterprises well, your ESCOMs, your SAAs, and so on. And the rich are really fed up because they pay a lot of taxes, while the poorest of the poor are also fed up because they're not getting service delivery in their communities. And there's really nothing we can do to the government to tell them to really shape up and do what they're supposed to do. We really can't revolt against taxes because it's against the law. And although people do engage in protests, sometimes those protests are not peaceful and they end up being illegal. So there's really nothing we can do except that we can reduce our taxes and plan our taxes accordingly. And when you create wealth, that's what I want to equip you with, to be able to reduce the tax accordingly and so on. Also, maybe you're still starting out at your job and you're like, well, I don't think this is relevant for me because I'm not really earning a lot of money. I'm earning like less than 10,000, 6,000 rands or whatever. As a young graduate, I know a lot of people earn like 8,000 rands in like internships. But also, if you're in a graduate program, you are earning good money, like 15, 20,000 and so on. Even though you're earning little money and you're not earning a lot of money, or you haven't received and earned that amount of money you want to earn, it's quite important for you to listen closely to this information, because it will help you when you start earning more money through your wealth creation activities, or maybe when you get a promotion at work, or you get an increased remuneration package, or you want to start your side business on your personal capacity, and what deductions will you have to reduce your taxable income and ultimately pay a lower tax, and so on. So all in all, it's crucial that you know your taxes and you know how they are determined in order to inform your wealth creation activities. With that said, let's now get into the gist of today's tutorial, which is determining your taxable income. So now the first step in determining your taxable income as a taxpayer is to ascertain and determine the amount of gross income received during the year of assessment. And to determine your taxable income, you move a step back and determine your gross income received during the year of assessment. Now, in order to understand what gross income is and what amounts are included in this gross income, I'd like to just tell you about this gross income definition. Just read it out because it's something that is in law and it's not changed. So here's the gross income definition. Listen attentively. Gross income in relation to any year of assessment means, in the case of any resident, the total amount, in cash or otherwise, received by or accrued to or in favor of such resident during such year or period of assessment, but excluding receipts or accruals of a capital nature. And in the case of any person other than a resident, it's the total amount, in cash or otherwise, received by or accrued to or in favor of such a person from a source within or deemed to be within the Republic of South Africa. Now, I have to break down this gross income definition and make you understand it bit by bit. The reason why I do this is because this definition has been subject to a lot of court cases in South Africa, which have made it more clear over the years as to what to include in gross income and what not to include in gross income, and the intention of the definition itself. And all the decisions that were taken and the court rulings and the determinations that were taken are then incorporated in the gross income definition in order to make it clear and so on. The first part is in the case of any resident. Now, South Africa's tax system is called a residence-based tax system, and SA residents are taxed on their worldwide income. Now, to avoid double taxation, all foreign taxes paid by residents will, however, be allowed as a tax credit against the South African tax liability. So take Trevor Noah, for example. Trevor Noah is a South African and he is taxed on his worldwide income as South African. So although he earns money in the USA, he is taxed in South Africa for that money. But to make this more clear, the US itself will not just let him slide and say, no, you're going to be taxed in South Africa. He's actually going to be taxed in the USA, and then once his income is declared here in South Africa, then they'll give him a tax credit here in South Africa because they have a tax treaty agreement with South Africa. The US and South Africa have a tax treaty agreement, meaning that all the taxes he paid in the USA, he will not be liable to pay here in South Africa when he also completes a year. So although it's a resident-based tax system and he will be liable to pay tax in South Africa, he will first pay tax in the USA where he applies his trade, and then after that, when South Africa says, pay tax, Trevor, because you are a South African resident, he will say, I already paid tax in the USA. Here's my tax return from the USA, and then they'll credit all of those taxes he paid in the USA against his tax liability in South Africa. So that's how it happens. Now, case law was also involved here. There were cases that were determined in court as to what is a resident and who is not a resident and who is a resident. So it was said a person is an ordinary resident of that country if that person's permanent home is in that country, is in South Africa. this is the home to which he or she will return from their wanderings. Now, this part of the definition is very subjective, and you may never know if a person will return or not, and only the person actually knows deep down inside. So, in the case of Trevor Noah, we don't really know if he will come back from his wanderings in the USA and come back to South Africa, or he will stay there permanently. We never know. So that's the test that case law gives in terms of determining if a person is an ordinary resident of the country. Over and above that test, though, there's also another test they give, which is called the physical presence test. So the physical presence test, I won't go deep into it, but it's a test that determines how long a person has been in the country and how long have they been outside of the country. And in that test, it might happen that Trevor, after a certain period of time, will not be regarded as a South African taxpayer. Even though he has South African citizenship, he will be regarded as a US taxpayer because of the definitions on that physical presence test. I will include a link on some lectures from the University of Cape Town where they explain all of this gross income definition and this physical presence test, because it's something that goes really deep, and it's not for the layman, if I can put it that way, but it's for people who are actually learning tax. But if you are interested in understanding case law and understanding how tax came about, because the videos are quite interesting and they're not that hard to actually follow, I will add links to them on the show notes on the samkelomag.co.za website, so you'll check them out there. So that's the first part, which talks about in the case of any resident. The second part is the total amount in cash or otherwise. Now, there must be an amount received or accrued for gross income to arise, and this amount must be in cash or otherwise. So, an example of something that is in cash is your monthly salary that you get paid into your bank account, that is in cash. Another example of such amount is the money you get from your business. If you sell goods in your business, that is the amount that is in cash. But another amount that is in otherwise, that you can say as an otherwise, is the contributions made by your employer to your pension fund. You don't necessarily receive this amount. You don't actually receive this amount in your pocket every month, but your employer buys a certain portion of pension and other employee benefits on your behalf using their own money. So that money is then added onto your gross income or to your earnings, because you wouldn't have that group life cover, you wouldn't have that pension fund, that extra contribution on your pension fund, if it wasn't for the sake of your employer and that employer-employee relationship. Now, you must note that it's not necessary that this amount be made out of money, as I say, as long as the amount can be ascertained in terms of money value. Also, sometimes you find that employers may give out cars at reduced prices maybe to employees, and all of that can also be included in your gross income as the total amount in cash or otherwise, if it's not in cash. The next part is it must be received by or accrued to or in favor of such a resident. Now, the money must be received by you or accrued or be in favor of you as the resident. The first part is very clear, because when you receive money as a result of your employment, for example, you received it. It gets into your bank account. Or if you've sold goods on cash, you receive the money. But when it comes to the accrued part, it's a bit tricky. And to explain this, I'll make an example about accounting. An example I actually learned in accounting. There's a concept in accounting called the accrual concept. And this concept is used by accountants around the world and is regarded as a generally accepted accounting practice. Now, it states that income is recorded when it is earned and not when it is received. And expenses are recorded when they are incurred and not when they are paid for. So what this basically means is when you make a sale of a good, that's when you record the income. That's when you are entitled to that amount, regardless if the taxpayer will pay you next year or 3 months later. And also in terms of expenses, when you incur the expense now, even though you are incurring the expense and you pay later, but you are incurring the expense now and you have to record it now. So this is quite important for you to understand, and I'll link it with the next part of the definition, which says during such year or period of assessment. Now, for natural persons such as you and me, the period of assessment starts on the 1st of March and ends on the 28th of February each year. So it overlaps. So right now we are on the 2019-2020 tax year, which started on 1 March 2019 and it will end on the 28th of February 2020. So in other words, South Africa's fiscal year starts in March and ends in February. Hence why you always see the budget speech delivered in February, preparing for the upcoming tax year. Now, I want to link this to the accrual part where I talked about received by or accrued to in favor of such a resident, as well as to the part where it says during such year or period of assessment. Now, let's make an example and say you sell goods and you have a store in a tuck shop, and you sell goods on the last day of the financial year on 28 February or 27 February or 28 February. You sell them on 28 February and you don't receive cash for those goods today. And the person you sold these goods to, you sold them on credit and they say they're going to give you your money on the 10th of March. So you sold the goods in the 2018-2019 tax year on 28 February 2019. And you only receive payment on 10th of March 2019. So the goods you sold were actually from the previous year of assessment, which is 2018-2019 year of assessment. And you must include that income in that period of assessment on the 2018-2019 period of assessment, regardless that the person will pay you your money during the 2019-2020 tax year. So this links into that accrual concept in accounting when it says income is recorded when it is earned, not only when it is received. So that's when you earned that income. So you record it during that tax year, that period of assessment, and not on the following period of assessment where you would receive it. So that's quite important. And the final part of the definition says excluding receipts or accruals of a capital nature. Now, capital gains are included in your income tax. Don't get this, guys. Don't get this wrong, guys. But for the purposes of your gross income calculation, capital gains are not taken into account in this part. They are taken into account at a later part of your tax liability calculation. So that's basically the gross income definition. I hope it's clear. If you have any questions, do ask on the comment section, on social media and so on. Now, just to close on this capital gains and ideas of what are included as capital transactions and ideas of amounts that are not capital transactions, which can be included in gross income. So capital transactions are transactions such as selling your house. If you sell your house, that amount won't be included in your gross income because it's of a capital nature. If you are selling your private motor car, if you are selling your unit trusts which you held as an investment, if you are getting a receipt of an inheritance or a donation and so on, that won't be included in your gross income because it's of a capital nature. And if you are selling houses and you are a property dealer, that income is included in your gross income. If you're selling motor cars and you're a car dealer, that amount will be added to your gross income. If you are selling shares regularly, you buy and sell shares, you trade shares, that amount will be included in your gross income. So if you are a trader, then you are liable to pay income tax on your profits that you made because you buy and sell shares regularly and so on. This also includes then now the receipts of your salaries, commissions, and interest. Those will be included in your gross income. Now, as you can see, in these examples, on the capital transaction examples, I made an example about selling your house, as well as on the gross income transactions, I made an example about selling houses. But if you are a property dealer, now intention is quite important here. Intention is crucial, guys. It's important for us to know, or for SARS to know, what do you intend on? Are you just buying and selling these goods just for the sake of having these houses, or is this your primary residence? Is this your home, or are you buying and selling these houses so that you can generate an income? So intention is quite important to determine whether something is of a capital nature or if it's of an income nature. So that's basically it. But in closing, also for this capital part, another important thing for you to understand is that when you look at the analogy of a tree and a fruit, they always make an analogy of a tree and its fruits. So if you take a tree of apples, when you have this tree and cultivate this tree and you harvest the apples and sell them, that is an income generating activity which will require you to pay income tax on that. But when you sell the tree and the land that has the tree and you forfeit your rights of actually harvesting the tree, then that is a capital transaction. So that's also quite important to understand. So that's gross income and the gross income definition. So that's how you see what amounts to include in your gross income as a whole and what amounts not to include in your gross income. You look at that definition and you see if these amounts fall in this gross income definition or they don't fall in this gross income definition. And this will include your salaries that you get. It will also include commissions if you're a commission earner. But if you also have a side business, it will also include that amount of money that you get from your side business. Now, on top of the amounts that are in gross income, that are included in the gross income definition, there are also other specific inclusions that are just special and that are not taken into account on the gross income definition. And these includes things such as your fringe benefits. These must be included in your gross income. For example, if you have gross income, if you have a private use of a company car, if you have a housing subsidy, if you received an interest-free loan from your employer gave you a loan and you're not liable to pay interest, that also must also be accounted for and included in your gross income, because it is an amount that you received. It's not in cash, but it's otherwise. So that's also included. Another thing that's included is your pension fund contributions made by your employer. Those are included as a fringe benefit. And another interesting one is lump sum benefits. Lump sum benefits such as retirement fund lump sum benefits. So a lot of people, when you have your retirement pension fund at work and you are about to retire, when you retire, then those amounts will be taxed. But I know a lot of people who are listening here, I know that the age is of 55, 60. But if you are around the age of 55 and 60, 65 at retirement age, the amounts you get from your employer, from your employer's provident or pension fund, will be taxed according to lump sum tables that are given by SARS, depending on what type of withdrawal you will be making or what type of lump sum you will be getting. Those amounts then will also be included in your gross income, but they will be taxed on a different table, but they will be included in your gross income also, so because you pay tax on those amounts. I've taken a lot of time going through this episode, and I hope everything is clear. And for the purposes of clarity, I won't continue from here. I'll just leave it at this instance. And On the next episode, I'll be because I've talked a lot about gross income. I'll touch on gross income once again, but I'll focus a lot on the deductions part of it, as well as